I wouldn't say trading is more of a job. I would say it's more of a business.
Sorry.
So the expectation to trade from a set time to a set time isn't really an expectation to set. You have major sessions. The best analogy I like to use is, for example, if you own a restaurant, you're not going to open up your restaurant at 2 a.m., 3 a.m. in the morning, right? You're going to open up at lunchtime, dinner times, right? Whether you have the peak amount of people coming to eat their food. The same way in trading, you have the major sessions. You've got Europe market 8 a.m. in the morning. You've got the American market 9:30 New York time. Majority of the movements will be around the peak hours. So, for example, FX accounts, London session accounts for 43% of total movement. You're going to find majority of that movement around 8 a.m. to 9 a.m., possibly around 10 a.m., and that's where things start to slow down. I trade a lot of equities, which is going to be 9:30 New York time, which is 2:30 UK time. The equities will move around the open, so that'll be around 2:30, 2:45, 3 o'clock. That's where you see majority of the movements. Towards the end of that time is where things starts to dim down. So the expectation to trade at a certain hour, be on your desk, and then close off isn't a realistic expectation. And I guarantee if you go to the market with that sort of mindset, you're going to very quickly find out that's not how things work. The markets will reward good behavior, and if you have that expectation that you have to trade here and trade there, the markets won't reward it. You have to know what you're looking for, go to the market at those set times, and just trade your movement. I wouldn't say trading is a job. I would classify it more as a business, and then you need to understand your role within that business. That you are the talent, and therefore you can't slack. You have to take it seriously. Every aspect of the business in terms of your P&L, your consistency rate, what things need to improve on. You need to be able to track that, and we can extrapolate that into many points in terms of as a normal business collects data, for example. You need to know your strengths and weaknesses. The only way you're going to do that is by having numbers and statistics. So journaling is very important to know what as I said, your strengths and weaknesses, what you need to improve on. One thing I like to say all the time is the life of a trade. The way a trade is born, let's say, is by first doing your analysis to justify if you're a buyer or seller. Personally speaking, I screenshot all aspects of it. So, for example, if I want to be a buyer and the market goes completely against me, it wasn't the entry, it wasn't the management, it was the buyers, right? So I know what to focus on. That's the first aspect. The second aspect then is the entry. What justified you placing the trade? Again, you can put a screenshot on that. And for example, if you get the buyers correct, unless you enter the trade, it goes long, you get stopped out and the market goes in a direction. Well, it wasn't the buyers, you've done the buyers correct. It was your entry, you got in a bit too early, let's say, right? So your bias, your entry. The last one is the trade outcome, right? What was the outcome of the trade? For example, let's say you banked 20 points and the market does 100. You've only banked 1/5 of the move. And well and truly, you need to be very efficient with your P&L. That's a good question. I think what you need to do is you need to try a little bit of everything. The best way to describe it is, let's say you're doing a general engineering course. You sort of learn one aspect of every field, whether it be mechanical, electric engineering, whatever it is, and then you're trying to figure out what suits you best, right? Same way in trading. I think if you're very new, you'd want to try a little bit of everything. Try a little bit of trading the foreign exchange market. Trade the stock indices, a bit of stock trading, the commodities, and then trying to figure out what works best for you, right? For me personally, when I was learning at 17, 18, I learned technical analysis within the foreign exchange market, and then found out a few years after that the equity market was something that suits me a lot better now. And I would say almost 95% of my trades are solely stock indices, right? But the point is, that's not saying that FX isn't a great market. I know traders that trade FX only. I know traders that trade stocks only, like myself, or whatever it is. So I think in terms of finding your style, you need to figure out what strategy suits your personality the best. Me personally, I'm very impatient. I want stuff done ASAP. So for me to hold a trade for a prolonged period of time might not be the best thing for me. Can I do it? I could. It's something I just don't prefer to do. I'd much rather go on that trading day, take a trade, get out, move to the next day, and just operate on on that sense, and that to me is my style of training. Very much what's happened on that day, take the trades and meet my rules, and then just bank out. So just to conclude, in terms of finding your style, try a little bit of everything, understand what you're looking for. That I'm not saying that go to a market and just start pressing buy and sell and hope for the best. Have a strategy, have a system you're going to use, and overall find out what process suits you best on what market. That's a good question. I think training the pattern, I think we can sort of categorize that in terms of a process. Whereas training the market is, I'm assuming, market goes up, you buy, if the market goes down, you sell. So training the process and training the market, the way I distinguish that is very simply having a process to use, which you're very disciplined by. And that's a good, when it comes to training, a lot of emotion, especially when you're very new to training, you might experience a lot of emotion, a lot of self-doubt, a lot of questioning yourself when making a decision. When you're training the process, all that emotion is gone, right? Because it's very either is or isn't. And therefore, logically speaking, about emotion has no part to play, right? It either meets the rules and you take it, or it doesn't and you move on. When you're trading the market, you're very simply sort of just, market goes up, you buy, goes down, you have that emotion. So I think that, again, to extrapolate that point, there's so many nuances you can go down by, right? Training the process means you're emotionless when it comes to trading. It means you have statistics, which goes back to the earlier question about training like a business. You can then figure out what is working in your system, what aspects of it is not working, what aspects of it do you need to focus on and improve on. Again, going back to the framework of splitting the trade in 4 aspects: bias, entry, management, and market outcome. You can then figure out, right, which of the process do I need to focus on the most. Let's say 8% of your trades are getting your bias correct and the entries are correct, but your management, you're leaving a lot of profit on the table. Well, then you can then focus on that aspect of the process, right? And then figure out what tools do I need to use in order to maximize that opportunity, right? You might find yourself using seasonality data, being at the very early stage of historical movement to the upside. Let's say you're on a Dow Jones trade, and seasonally for the next few weeks that were very bullish. If you're on a Dow Jones trade, you can then use that data, then say, right, I'm in a good area of the market, I'm in a good area of the trends, I'm going to let this trade run. And that could help you with your management. Whereas let's say you're just trading the market for the sake of it, well, it goes up, goes down, there's no data collection, you don't know what you're good at, you don't know what you're not good at. And the worst kinds of losses you can take is when you lose and you can't improve on, right? Because you can't figure out what you need to solve. And I think training is just trying to figure out what problems you're facing and then trying to solve them. And the benefit is we have the tools needed to figure out what to improve on. So I think to answer the question more directly, the process allows you to focus on what you're good at, what you're not good at, improve on it using numbers and statistics. Whereas just training the market is very much a gambling mindset, I'd say. My buyer seller. So statistically, if you look at, again, with the journal and the way I like to trade, I would say I'm more of a buyer. Me personally, if I'm in a historically bullish period, I would much rather hold out on selling and look towards buying more often and letting those trades run. Again, relatively speaking, right? Me holding trades might be a few hours, whereas end of day trade I might leave it for a week or so, right? With all that being said, though, I'm very indifferent to it. Statistically, I might take more buy trades and sell trades, but I'm very indifferent to it. It's either if the process is indicating a buy trade or is indicating a sell trade. If the strategy I'm using, if the process I'm using, if the conclusion is to buy or sell, I'll take it.
What's your preference?
Preference, personally, I'm a glass half full person. I'm always optimistic, maybe delusionally sometimes, but I'd much rather buy than sell. And I think as you get more experience, you'll start to look at the macro fundamentals. You start looking at companies' earnings, especially as we go into, if we look at where things are right now, right? And the start of 2024, inflation has peaked, which at the central banks are starting to suggest that we are starting to see potential cuts, which will allow companies to make more, which means the stock of that company will rise, and overall, the stock indices will go higher. Therefore, I'm naturally going to be looking to buy. And there's many vehicles to take advantage of the stock market rising. You can look at index funds, you can look at trading CFDs, you can look at buying the whole stock. So overall, although the question might be very simple, you can see how you have many different avenues you can go down of taking advantage of one said move. So I'm much, to answer you, I'm more of a buyer than a seller, especially when we look at the macro fundamentals of where things are with inflation, with the economy as a whole. When um, so yeah, more of a buyer, but it definitely depends on where we are, not just the technical side of things, but also the macro side of things. Post 2020, post pandemic, where we had so much money being flooded in the system, naturally things are going to get a bit messy as it did. But if we look at where things are now and the overall cycle of things, definitely looking to me more of a buyer than a seller. To finally summarize all those points, you can see we've gone through down different avenues, right? Macro fundamental side of things, looking at journaling process, what sort of style you prefer. I think definitely one thing that I would suggest for anyone that's looking at trading, no matter what level you are, new, intermediate, advanced, you want to make sure you have one system you can use religiously moving forward, and have a way you can track it using numbers, right? Numbers cut through any sort of space where it's very sort of is or it isn't sort of thing. So it's you want to have some sort of process where you can track, you can see what to improve on, and just do that day by day. Consistency is key, and that old saying where the person who enjoys the journey walks further than the person who enjoys the destination, right? So it's very important you know what the process is and just keep following along and stay consistent. If you enjoy more of this, if you want more of this content, just follow the account below.